Howdy, welcome back. Hope you're doing well. Today we're going to be examining Toll Brothers, and that's a company that was suggested by one of our subscribers. So thanks a lot for that. It's a very interesting company that I was looking to potentially buy some stock of myself some time ago. And we're going to be doing our usual, examine the financials and work on a discounted cash flow model. Basically go through the company and see whether it makes for an interesting purchase right now, especially amidst these current market conditions right now. So thank you for being here. If you're new, welcome. And you may want to subscribe to the channel because I'm making videos pretty much daily for a lot of different stocks and investing topics, mainly focusing on value investing. And please, if you enjoy this kind of content and video, please leave a like because that really helps grow the channel and helps me continue make more content for you. So, what's with Toll Brothers? First things first, we examine the outstanding shares as usual. We don't want to see any dilution here. And in fact, we are not seeing any dilution. We're seeing the opposite thing. The company is buying back shares, which is good for two reasons. Because now, if you were holding shares, let's say in 2016, your shares are now worth more just because there is less of it. And also, it kind of shows that the company is willing to buy back their own shares, believing that their shares are undervalued. So otherwise they wouldn't buy them, right? I mean, there are some companies that do buy shares that are overvalued, and that's not a good idea. But typically speaking, companies and executives tend to be smarter than that. And so they tend to buy back their shares when the stock price is fair or undervalued. So that's typically what happens. Now the company is paying a little bit of a dividend here, 1.29%, as you can see. And we're going to examine, the first that we're going to examine is the dividend, because I want to make sure that the company actually has the money to pay the dividend. And as you'll see here, the company is paying 1.29% in the current, based on the current price, the dividend yield. And that comes down to 0.17 per quarter in terms of dollars. And now I want to help you calculate the payout ratio here, because it's actually not provided for over here. And it's actually a good exercise to do as well, so that you understand how it works. Now, the first thing we want to calculate here is the amount of dividend that is paid per share, so the dividend per share. So as you see here, this is quarterly, so its year is 4 quarters. So if we multiply 4 by 0.17, we're getting 0.68, I believe. And actually, let me verify that by going to the income statement of the company. And you will see here that the dividend per share over here is what I said, 0.68 is 0.17 multiplied by 4. So we multiply by the 4 quarters in order to get our dividend per share. And we do have our earnings per share. And this is 7.14, the diluted one. And basically, the amount that is paid in dividends is part of the earnings of the company, the net income of the company, which is what EPS is. And so what we could do is do a simple division of 0.68 dividend per share divided by earnings per share. And let me actually bring my calculator up. And so I have my calculator here. You will see that if we do dividends per share, which is as we calculated, and we can see the whole thing, it was 0.17 per quarter multiplied by 4. It's 0.68 here. And if we divide that to the earnings per share, the net earnings per share is 7.14. And then we multiply by 100 to make it a percentage. And you'll see that our payout ratio is at 9.52%, which is basically what it used to be over here. Growing a little bit slightly, but actually is down from what it used to be in 2020, which was 12%. Regardless, any of these figures, anything below like 30 is absolutely fine, totally fine really. So no troubles there with paying out the dividend for the company. Now we're gonna take a look at the income statement and actually examine what the company is doing financially. You'll see that the company has a forward PE of 5, which may seem too low, and it is low, but you have to bear in mind that this is a different type of company than, let's say, your Apple or your Facebook. It's not a high-tech company that's growing massively, and so typically people are willing to pay less of a multiple for the company, for a company of that sort. And this is why you are noticing lower P's here, and it tends to be very similar with the industry. I believe this industry actually is about seven times earnings, really, their P's. So it's the regular is about 7 or so. It's still lower than the regular, but bear in mind that we're not looking at 20 or 25 in terms of a PE here. So the total revenues of the company are sitting at from actually 5.8 billion to 9 billion right now. And regardless of the fact that the company is not really a growth company, it's still growing pretty well here. Especially in 2021, they have grown 24%. Now you will see that 19 and 20 were not great years for the company. 18 was pretty good as well. So they do have some growth. It's not like they are 1 or 2% every year, or 0 or -1. It's not this kind of story so far. And the net income of the company is sitting at 500 million in 2017 and now at 890. So it is also growing as well. What about the balance sheet of the company? Are they making it better year over year? So the first thing that I want to examine, the total liabilities of the company from 5 billion to 6 billion. So basically they are about the same amount of liabilities, which is great. The company is not incurring too much debt here, so they are very, very well managed, it looks like. And the total equity from 4.5 to 5.3. Again, as you can see here, the company is growing its balance sheet, but you're not looking at explosive growth here. And that also has to do with the fact that this company is also paying dividends, and it's generally speaking an established company that's not really growing massively every year. That's not necessarily a bad thing, of course. So the cash from operations from 800 million, 860 to 1.3 billion in about 5 years' time. That's pretty good. And cash from investing, it's basically steady here, not much going on, almost flat. And the cash from financing, nice to see that the company is actually buying back shares, as we saw earlier. So you look at that, repurchase of common stock. This is fantastic for an investor. You love to see that if you're an investor. And they are repaying debt here. They do still issue some debt. This probably has to do with leverage and loans and all that, because they are in an industry where you can use debt to grow, and they are still repaying back some of the older debt. So that's very normal in terms of operations. And the free cash flow from 832 million, which is 0.8 billion, to 1.2 billion here. So still growing their free cash flow every year, apart from 2019, which wasn't a great year, and also 2018, it was less than 2017. But in the last couple of years, they have been doing much, much better here, so that's good. The multiples of the company are very, very low, as you would, again, kind of expect with this kind of company. And the profitability here is sitting at 18%, very healthy, the return on equity, using their equity and debt, basically, to grow the company very well and return money to stockholders. And the total debt to equity is a little bit elevated here, but that wouldn't worry me too much, really. And you will see here that their cash flow, very, very important, is sitting at 1.2 billion in 2021. And if you take a look at their balance sheet and we examine the total liabilities of the company, they are 6 billion. So it would take about 5 years of free cash flow to pay everything here. That's fair. That's very, very fair. So the company doesn't seem to be having a lot of liabilities here that could be very, very problematic in total current liabilities and long-term debt, which actually includes both things. Now, the next thing that I want to check here and examine is what the company is worth based on their cash flow that they generate. And remember, they're actually paying out some dividends to stockholders, so that's a good, nice extra to have. So we're going to be using our trusty doc, which is a discounted cash flow model. And I have already appended the free cash flow and the outstanding shares in million over here. Now I'm going to be very, very conservative with the discount rate because this is a company, with the free cash flow growth I meant to use, because this is a company that's not likely going to be growing the free cash flow tremendously year over year. And so I'm going to be conservative. I'm going to go 5%. And I may actually be even more conservative. Again, this is not a company that's a high flyer and a high growth company, so we want to be conservative, more conservative than our usual tech companies here, just to be safe. We have a better margin of safety. Now you will notice that the 5-year average free cash flow growth is 31%, but notice also that they have had massive declines as well, like 32%, 37%, and so you cannot just use this number and be safe for the next 10 years. That will be way too much. So 5% is what they would probably be growing at for the next 10 years. That I think that makes a lot of sense. So the perpetual growth rate of 2%, and the discount rate that I want to be using here, it's not a very risky company, so I'm gonna go with my typical 13%. And as you'll see here, my calculator here turns back that with the number 116, and this is the amount that we should be willing to pay in order to be making 13% a year on our investment annually. And so if you look at the current stock price, it's sitting at 52, 53 almost, which is half that, and basically pointing to a company that's undervalued right now in terms of how much the free cash flow they are making, and what is their market price. And so I like what I'm seeing here. I mean, I like the company making good amounts of free cash flow. And even if I go, let's say that I go 0% here, so the company is not growing at all its free cash flow. It remains the same. Look at that. It's actually the same from year 5 to 10 years from now, same every year. Now, if that happens, if that scenario happens, we are looking at $84. And again, we are currently at 52, right? So we have a margin of, and also margin of safety. And even if the company grows minus 5%, look at that. Now the company is actually losing 5% every year. And we are still above the purchase price. So that's pretty great. I mean, the company has tons of safety in terms of a margin here, margin of safety, just because they are making a very, very good cash flow, based on their actual market cap. So the company's market cap is 6 billion, and they made 1.2 billion in free cash flow. That's insane. They made a lot. Like, look at that. $6.3 billion for a market cap. And let's go back to the cash flow statement. And free cash flow 1.2 billion. So they made in 1 year as much free cash flow, actually 1/5 almost free cash flow of what the whole company's market cap is. You see? So we're talking about a company that makes tons of money when you compare it to their market cap. And that's important. So I do like Toll Brothers a lot here. And I think that's a very, very interesting buy, especially as it's going down right now and we're having a market that could potentially even price it lower. Because again, market fluctuations and sentiment will potentially bring this down even more if this continues right now, what we are facing with the current bearish trend, because it's not about the company, but it's about the energy, it's about the sentiment really, and about what's happening with trading when you're looking at this kind of short-term movements. But over the long years, over many years, as the company is making more and more cash flow, increasing its balance sheet and all that, this will definitely come to reflect what they are making. And a company that's worth $6.3 billion and is making $1.2 billion every year, well, that can't stay down for a long time, can it? So thank you for watching this one. Hope you enjoyed the video. And if you did like this video, you may want to take a look at this one that I made earlier, and I'm discussing Alibaba and why I think it's a screaming buy at near $100 where it is right now. And I'm actually examining why and taking a look deeply into the financials of the company, just to potentially cure some of the fear that people have in regards to Chinese stocks, and especially a stock like Alibaba. So thank you for watching this one. I'll see you soon. Bye bye.